Slightly softer than expected inflation numbers from the US didn't get investors worried much at yesterday's trading session, but the economic weakness, rising oil prices and sticky inflation do worry everyone here in Europe. See, we don't even know what the European Central Bank will do when it meets today, but we know that the pricing now gives slightly more chance for an interest rate hike from the Europe today than a pause. So welcome. This is Swissquote's Daily Market Talk. So yesterday's CPI report in the US was mixed. It was worse than expected and far from soothing, really, because the headline inflation in the US ticked from 3.2% to 3.7%, which is higher than the 3.6% expected and penciled in by analysts. And core inflation came in at a 4.3% level, in line with expectations, but on a monthly basis, core inflation was slightly higher than expected by analysts. And as you certainly guessed, well, the spike that we saw in energy prices recently was obviously to blame for the rise in the headline figure in the US. In fact, gasoline prices in the US rose by more than 11% in the month of August, and that actually accounted for more than half of the overall monthly rise in inflation alone. Now, the only good news in this data set was that core inflation in the past 3 months actually ran at a 2.4% annual rate. So that's the lowest level since March 2021, and that is just at a spitting distance from the Federal Reserve's 2% inflation target. So that's maybe, but just maybe, why the market reaction to a higher than expected set of monthly and yearly inflation figures from the US didn't really see a bad reaction. So the US 2-year yield was shortly above the 5% psychological mark at yesterday's trading session, but it fell after the CPI data was released in the US. Activity on Fed funds futures now gives around 97% chance for a pause at next week's FOMC meeting, but the probability of a pause in the FOMC's November meeting is now slightly less than before the data at 56%. So yesterday's CPI data tilted the expectation for a November hike slightly higher, without, however, changing the consensus of a no rate hike for the moment. Now, I say for the moment because these expectations, these market expectations about the rates could change, and they could change quite rapidly. I mean, this is what happened for the European Central Bank, because not earlier than the beginning of this week, I mean just this week, the expectation for today's European Central Bank meeting was a no rate hike. And today, well, just a few hours before the ECB meeting, before the decision, well, the pricing is pointing at a 25 base point hike as the most likely scenario. Now, note that the most likely scenario for what the European Central Bank is expected to do is much less certain than what the Fed would expect to do in that most likely scenario, because the ECB is not much worried about, surprising the market on one way or the other, as I was saying earlier this week. So yes, today into the European Central Bank meeting and decision, money markets are pricing in a 68% chance for a 25 base point hike. And, well, interestingly, there was nothing positive on the newswire yesterday or at the beginning of this week to justify that change in expectations, because released yesterday, the Euro area industrial production figures were actually rather looking bad, with a more than 1% slump on a monthly basis and a more than 2% slump on a yearly basis. So that's also why I think that the higher European Central Bank rate hike expectations, well, couldn't really help the euro dollar recover above that 107.65, 107.70 range, which now acts as a decent resistance before the European Central Bank decision of later today. Now, if the ECB raises the rates today, well, the euro dollar could actually see a rapid jump towards toward the 200-day moving average, which now stands near the 108.25 level, and the Stoxx 600 index could actually slip below the 445 level, where we have a double bottom formation since the beginning of the summer. While there is a decent downside potential in the European stocks, well, I think that the upside potential in the euro dollar, however, is much limited by obviously the weakness in the recent economic data from the Eurozone. In fact, the gap between the US and the German 10-year yield, well, has been narrowing since about 3 weeks now, but the euro dollar barely benefited from it so far. On the contrary, while the euro dollar weakened more than 1% during the same period of time, so during the past 3 weeks. And according to Goldman, that breakdown between rates and the currency valuation is due to inflation uncertainty, and it's the inflation uncertainty that's according to them pushing these yields higher, and not necessarily the rate hike expectations. So it's a bit complicated because those are all communicating vases, but to me it's just a morose economic outlook that brings investors to think that, well, even if the European Central Bank hikes its rates today, well, it will certainly be the last rate hike in Europe, and that in less than a year from now, well, we will actually be talking about the first rate cut in Europe due to economic weakness. So that's it really across the channel. Well, unfortunately, the picture is not sunnier. Well, it's never sunnier in the UK. Well, latest data revealed that the British economy actually shrank at the fastest speed in 7 months in the month of July. And well, strikes and the lack of sun were actually responsible for the morose economic data that we received recently. And that's not it, because you would think that, well, the slower economy could at least mean a softer inflation for the UK, which is not all bad news per se at this moment in time, but no, because data released earlier this week in Britain show that, well, the British unemployment rose, but the British wages grew at a record high, the record starting from 2001. So the Brits actually earned 8.5% more on the year, which is obviously very good news for their struggle to keep up with the cost of living crisis that they're having on their little island, but it's clearly bad news for the Bank of England, which is on its end trying so hard to abate inflation in the UK, but in vain. They seem to be abating economic growth instead. So cable is now testing the 200-day moving average to the downside this week for similar reasons to the euro's depreciation against the US dollar. The rate hike expectations for the Bank of England are strongly here, obviously, but growth outlook for the UK looks so gloomy right now that not many traders are actually willing to try to open a long sterling position. Now, for all these central bankers and all those who want to raise interest rates and all those who don't want to raise the interest rates, well, the headache is quite the same at the moment. Oil prices are rising, and that's obviously muddying the future inflation expectations and the future rate expectations. The US is maybe and certainly in a better position than the rest of the world, because at least they don't have to worry about currency depreciation, which makes things even worse for the others. But hey, the barrel of US crude came very close to the $90 per barrel level at yesterday's trading session. Now, happily, the latest EIA data showed a 4 million barrel build in the US inventories last week, which certainly helped not boost the bull's run further. But oil market is now swamped with buyers. The RSI index hints at overbought market conditions, and the $90 per barrel level is a psychological resistance. And on top of all that, while the global economic data hints at slow activity days ahead of us. So I would expect at least a minor downside correction to happen at the current levels. In the equity space, well, all eyes are on ARM today. That will be going public on Nasdaq. The company set its IPO price to $51 a share, so it's at the top end of the proposed price range. But keep in mind that it's still lower than the valuation of $64 billion when SoftBank actually bought out a stake held by Vision Fund. So fasten your seatbelts, guys. We shall see some nice and wild price action today. So this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and interesting and insightful comments. I hope this episode of Market Talk has also been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions and your questions below as usual, and follow us on Instagram, on X and on LinkedIn for regular market updates, and subscribe of course to our YouTube channel for daily market comments. I will meet you again tomorrow, and until then, good day trading.